On Thursday and Friday, we saw energy stocks get hit pretty hard. Energy stocks have been going up. Oil prices have been going up. Everything was fine for that trade. On Thursday, we kind of got a little suspicion that something was going on. We took some profits out of our energy positions. And then, of course, Biden comes out with executive orders right after that and says, hey, we're going to kill the XL pipeline and we're going to ban drilling on federal land. Now, that was an unexpected event that energy companies were not betting on. Right? That wasn't even on the radar at the time that would happen. Now, I think there's actually some positive things out of that for energy companies. First thing we didn't need was more oil coming out of Canada going to Cushing, Oklahoma that would boost our supplies. We already have an oversupply problem, so we need prices to come up. And to get prices to come up, we need supplies to come down and demand to go up. That makes prices rise. Cutting drilling on federal land is not great for some companies. For other companies, is better, right? If I have a company that doesn't drill on federal lands and oil prices go up because now we've cut 20% of production from being able to drill on federal lands, and we've cut the oil supply pipeline. So now there's a potential setup here for a reduction in actual supply from the U.S. You know, it's interesting, for the last couple of years, we've been talking about OPEC cutting production, but we were producing like crazy. So whatever they were cutting, we were oversupplying. Now we may actually get a production cut globally, which could lead back to a supply concern. Oil prices back up into $100, $150 a barrel. There you go. There's your inflation. Therein lies also some of the other problems, right? That's an unexpected consequence, right? Banning drilling on federal land. Unexpected consequence. This is also the beginning of the end of the financial system as we know it, as Janet Yellen was now appointed the first woman Treasury Secretary. I'll spit that out. Yesterday, of course, I'm just joking a little bit, but in a way I'm joking, in a way I'm not. This now, as we wrote about an article, I guess it was a couple of weeks ago, we talked about the arranged marriage between the Federal Reserve and the Treasury. And this, of course, closes that loop now between Jerome Powell and Janet Yellen. So this will make supplying liquidity to the markets much easier because, again, every time the Treasury has to issue debt in order to cover its spending, any spending that goes beyond the revenue that we collect, this is called our deficit spending, has to be funded by debt. What the Treasury needs is a guaranteed buyer of that debt, particularly since our foreign trading partners really don't have an appetite for our debt at the current time. So this kind of closes that loop and ensures that the Federal Reserve can try to keep interest rates suppressed. And this also sets up the dynamics we've talked about here on the show with Michael Leibowitz recently, yield curve control, to try to keep the yields capped on fixed income. Now, the problem with that, of course, is that interest rates should have a modicum of discovery of risk. The interest rate should reflect a couple of things. One, it should reflect the credit risk that you're taking. So in reference to corporate debt, if you're buying, say, bonds in GameStop, which is virtually on the verge of bankruptcy, that yield should be substantially higher than what you would get paid for owning a U.S. Treasury, which has a very low risk of default, right? Yield should also reflect inflation. And the reason that is the case is that if I'm loaning you money for 30 years and we expect inflation to be higher, so let's say that we expect inflation to go to 3% average over the next 30 years. Well, why would I loan you money for 30 years at 2% if inflation is going to be at 3%? So interest rates should reflect inflation over time. The problem with yield curve control and the suppression of interest rates is that it breaks those relationships. They came out with this article on CNBC saying, becoming an investor is the new American dream, just like home ownership was before. I think everybody should invest, right? The younger that we can get people investing the right way, the better off we're all going to be. Look, only 10% of households own 87% of the stock market. We've talked about this before, right? The rich own the stock market. Everybody else owns debt. So getting people involved in the stock market is great. The problem is, Robinhood is a great platform for trading stocks, but it doesn't teach people how to invest. It teaches people how to gamble and to do things like they're doing now, like chasing ultra shorted stocks to run them up in price. And this is all fun and games until things go horribly wrong. And when you have this type of activity in the market, these things always eventually go very wrong. And there's a lot of signs that we're very late into the stock market cycle, right? Take a look at the number of companies that are going public through what's called SPACs. These are special purpose acquisition companies. Basically, these are just blank check companies. People write checks literally into a company that has no business model, and then the company tries to go out and find something to buy to put into the SPAC to make it have a viable business. That's what we're doing here, and that is just a backdoor way to IPO. We have a record number of IPOs coming out of companies, and that's fine too. But why does the company go public? A company goes public when they want to maximize the value of their business. Now, Danny and I are going to go public with our company. The company's worth $1 million in our widget model, but we're not going to sell it for $1 million. That's what it's worth. That's the value of the business. Companies go public to sell things at a big premium, right? This is Danny and my opportunities to cash in. We're going to sell all of our shares to you at the highest possible price. So the more frantic the market is, the higher the price is, which means that you're overpaying for value. Now, these are the things that you see at the peaks of markets. When do you not see a rash of companies going public or people just writing checks into blank vehicles hoping to find a business? You don't see those where? At the bottoms of a bear market, right? There's no value. There's no premium in a bear market because nobody wants it, right?
And as a buyer, that's when you should be buying.
As a buyer, that's when you should be buying. Absolutely right. The problem for the Federal Reserve, though, is that this is the one thing that undoes their ability or limits their ability to do these type of monetary supports, quantitative easing and all these other programs, because the whole premise, and I even mentioned this yesterday, is that, yeah, we're having this recovery. Now, if you listen to mainstream economists right now, the economy's booming, right? We're just growing gangbusters. And this year, we're going to be at 5.8% economic growth, according to Goldman Sachs, and we just couldn't be doing any better. And there's this massive amount of pent-up demand that's just waiting to come into the economy. Once we get everybody vaccinated back out in the world, it's all going to be awesome. But the Federal Reserve said yesterday, is like, yeah, we're seeing some signs of recovery, but we're not convinced it's here, so we're going to keep doing these programs. What happens, though, once that inflation gets to 2% and we do get back to full employment, and then all of a sudden they've got to start figuring out what to do next?
If you kind of look at all the different scenarios that can play out over time, the scariest scenario may be good economic growth with inflation. That may be the scariest scenario, or stagflation, which is poor or even negative economic growth with inflation. But inflation is what can really be a problem for the Fed, because if there's inflation and it's above the 2, maybe even 2.5 that they would like to see it at, the Fed's going to take action. So what does Fed action mean? Higher interest rates, taper QE, reduce QE, do the opposite of QE, QT.
Right.
Get rid of the stimulus that's feeding the markets. It's not feeding the economy. Broadly speaking, it feeds the markets a lot more than it feeds the economy, right?
Exactly.
So we may be looking at, maybe Goldman's right, but if we're going to grow at 5.86%, it's probably almost certain that inflation is going to be running hot.
Right.
And then the question is, will the Fed basically drain the punch bowl? Maybe that's what they did yesterday. They said, look, we're a little concerned. We're going to take out a little of insurance, so we're just going to take a teaspoon of rum out of the punch bowl. There's still, this punch bowl.
There's still a full fifth in there, but they took a teaspoon out.
Right.
Come and shake your body, baby, to the conga. No, you can't control yourself any longer. Come and shake your body, baby, to the conga. No, you can't control yourself any longer.
And welcome back. Thought we'd put in Michael Leibowitz's morning dress theme as he gets dressed in the morning.
Where does this come from, Lance?
we have your house wired, so yeah, we know what you do. Yeah, in the morning, hairbrush, towel, through the conga.
That's the way it works. You figured me out.
Love your feathered bola.
Exactly. All right.
If only it was that exciting.